Assalamualaikum and a very good day. Today I'm going to share with you the third topic, the third chapters, that is equity financing for real corporate real estate, yeah. Understanding the real estate equity financings. Right. Okay. First of all, we need to know you need to understand what is equity financing concept and how financing real estate through equity. The tax implication on the equity financing is the financing through debt is the best option for real estate financing. So we were going to look at it. Okay, financing, equity financing. The advantage of equity financing, of course, is lower risk because no personal guarantee or promise rate, higher rate of return is required under equity financing. Capital contribution, the equity fund bring more flexibility, liquidity, and possible higher of return on equity, return on investment. So capital cash flow, unlikely with the debt, equity financing require no monthly repayment obligation. There is no obligation of paying back, and because this is or belong to the owner, equity is belong to owner. So when the equity is actually being contributed by the shareholders is the owner of the company. And so no requirement to pay back the obligation. No cash benefit. Bring the wealth of the knowledge and experience to the project. Okay, and however, there's disadvantage of equity financing in terms of accountability, answerable to the investors. Loss of control, going to lose of the control, needs to satisfy the need of majority shareholders and tax shelters. The under equity financing will not gain any tax advantage over the tax saving and the higher profit sharing lah. Okay. So equity financing, what is equity financing? Is raising capital to buy commercial properties, real estate, commercial real estate through equity investors. In private equities, investors pull together enough or sufficient fund to purchase the commercial properties. Investor will typically receive a percentage of shares of the entity that own the investment, and therefore the share of the income and other benefit generated from the property. Okay, so property owner or the sponsor of the deal responsible to split the profit with the investors according to the percentage stated in the operating agreement. So investor will tie up to a private equity agreement that require investor to stay in place in that particular company, in which this will distribute the revenue in form of dividend as long as the business is running or profitable. However, on the other hand, if the investor wish to exit the company, they have to make sure there's another investor willing to buy. This is a setback of the private company, willing to buy the shares according to the share transaction, according to the market valuation per shares. And the share transactions is according to the negotiation of agreed price to both parties. So rising private equity cover down payment and on the investment and utilize the commercial maybe commercial loan to recover the remainder. Okay. So similar to structure to private company, but this is bit more structures because they going to govern by the security and exchange commission. Okay, a deal sponsor will go out and find the opportunity of a group of investors. This real estate syndication is actually you're looking forward on how much they will need to fund the and hopefully can be done through a feasible study of the site and potential. The syndicate can be very specific purpose compared to the private equity, where the investor can simply pool their money together and before they know what are they investing in. Okay. So how real estate financing through equity is conducted? First is maybe issuing new equities. Some of course they're going to have a seasonal equity offering, or we call it SEO. Another one is another type of equity is common share and preferred share. What is preferred share? What is common share? Another one is last one is what we used to hear is actually REITs, real estate investment trust, and the newly introduced in our body to know our industry is property equity crowdfunding, or we call this ECF. ECF is equity crowdfunding. So property, specifically property equity crowdfunding, is to fund the PCF. PCF way of funding to for the property purposes. So equity, what is newly equity issuance? Every company, a listed company already listed in the company is and to be done as IPO is actually and have a share outstanding, meaning to say the company previously was actually maybe in a form of private company, and then they want to convert into a how to say a public company. So there's going to be an IPO. IPO. You can read it further lah. IPO and SOE. Okay. Okay. So we're going to differentiate between types of equity in share issuance, in the stock issuance. Some of people call it stock, some of people call it shares, but actually shares and stock is common thing. Okay. We call it common shares. Another one we call is preferred shares or preference shares. What is common shares? Common share is representing the ownership of the corporation. Meaning to say, if you come to the company and you were to be called as a common share, as a common shareholders, you are the owner of the particular company. So in terms of liquidation, let's say the company come into a liquidation, the common shareholder will receive whatever asset remain after the creditor, the bondholder, and preferred shareholder are paid. And this is because they are owner. So the creditor, the bondholder, and the preferred stock shareholder need to be satisfied first. And then you are the last one who going to benefit from whatever remain of the company if the company come into a liquidation. There is a difference between variety of stocks traded in market. For example, the value of the stock, lower price related to their fundamental, and growth stock that a company tend to increase the value due to the growing earnings. So investors should diversify their portfolio, putting the money into a different security based on their risk appetite. The return on investment incurred in terms of companies is actually what we call DPS, dividend per share. And after taking into a consideration other commitment, after taking into a consideration of whatever payment made by the company. So remember when you learn account with Dr. Rusaimi, the net profit after interest and tax, the profit after interest and tax belong to the company. Partly will be reserved as a retained earning, and partly will be distributed as a dividend per shares. So that's what we call dividend per shares. However, in terms of preference shares, this the attributes of preference share are similar to the bond. Meaning to say, this particular type of share usually going to be offered higher price compared to the common stock. So company stock with a dividend that are paid before the common shareholder are paid. And there are four types of stock: cumulative, non-cumulative, and participating, and convertible. Preference share are deal with a risk adverse investor, because they are called as the issuer that can redeem them at any time. And usually the price of more expensive, as I said just now, and guaranteed return of investment to be paid to the investor. Okay, so there's a difference. Okay, if preference shares, they're going to have no voting right because you are not owner of the company. But as a common share, you have voting in the company because you are the owner of the company. Right to the dividend, right for the fixed dividend, no share in the earning, for the preference, but they're going to have a fixed maturity of shares. As I said just now, common shares is actually the owner of the corporation, so they have right for dividend of the company. Yeah. So this is actually another we know as a right issue. Right issue is actually an invitation to the existing shareholders to purchase the additional shares in the company. This type of issue giving the existing share security of what we call a right. And with the right, the shareholder can purchase new shares at the discount to the market price on the state future date. The company is giving shareholders a chance to increase their exposure to the stock at a discount price. A right issue is one way for cash-strapped company to raise capital, often to pay down debt. Shareholder can buy new shares at discount for a certain period. Okay. And of course, in order for a right issue, there's a way on how the right issue going to be conducted. We call this theoretical X right price, meaning to say, like say, X right price, we call it TRAP, T-E-R-P, TRAP is a market price that the stock will theoretically have a following additional issuance of share via right issue. Company may use the right issue issuance to offer more shares to the shareholders, usually at discount price, and stock price are affected with a new right issuance because it increased the numbers of share outstandings. So this is going to happen. So like say a company, a particular company that is actually previously it was in a private private company status, contohnya Senyap Berhad, and they want to be a Berhad company, they want to be a private public company, they're going to have a process what we call IPO, IPO. So how to finance real estate through equity? Okay. Another way, this is the third way on how we were to finance real estate through equity. What we call as another form of shares, we call as a REITs, a real estate investment trust. What is real estate investment trust? It's a company that own, operate, and finance in income producing properties. Sama juga is income producing. It only finance income producing company. It's not going to finance like you're not going to finance like company deal with consumer good. It's going to finance whatever company that income producing properties. Finance to perform finance for company, not for financing new property developments. Okay, in Malaysia, government Malaysia do not allow our REITs to start as development REIT. We are only allowed to be in a form of equity REITs. Malaysia REITs is a type of equity REITs. Not to finance new property development project, because we are uncertain as to whether that particular new project development going to producing income producing property or not. Okay, so property in REIT portfolio produce rental income that is considered as net operating income distributed through a dividend per share to the shareholders. Okay, REIT generate a steady income stream to the investor but offer a little way for capital appreciation. Okay, REIT usually will have a higher income because the distribution of the REIT is actually 95%. Okay, REITs do not pay tax. And I don't think REITs are being given a specialty about REITs. They do not pay tax, and REITs need to distribute 95% of its net profit after interest and tax as a dividend distribution. So this resulted REITs to pay the investor higher than the average company. And however, because of REIT is actually generated a steady income stream, so usually the shareholders of REIT, when they invest in REIT, they don't want to sell the REITs. They don't want to sell the REIT. It resulted that REIT price is stable throughout the period because they enjoy receiving the higher dividend. So there is unlikely to have a price appreciation in the REITs investment. But as I said, REITs only receive dividend distribution. It's long-term investment goal, for a long-term investment goal. Most REIT are public traded like in stocks, which make them higher liquid, unlike a specific real estate investment. Okay, REIT invest in most real estate property type, including apartment, hotel, medical facilities, warehouse. Unique characteristic of REIT do not pay tax to the government. As I said, REITs are a form of a business or company does not pay tax to the government. Another thing is how we want to finance property is through equity, we call property equity crowdfunding. Equity crowdfunding is something new in our financial market. But this is a new idea of how we were to finance real estate investment through property crowdfunding, raise capital for investment purposes, real estate investment purposes. When developer or real estate professional find investment opportunity in real estate and they do not want to fund the entire investor themselves, so they will allow through to finance other kind of real estate people other investor can invest in the company through property equity crowdfunding, or we call it PECF, property ECF. Okay. So advantage is actually enable the shareholders to invest in real estate without having to own a low minimum of investment. You can access the estate asset that will be unaffordable anyway, but you can, because of the all the contribution, you can have the you can still own the property, but you're not able to manage the property. Because only you will have a minimum, low minimum investment in that particular property, would have a higher profit potentially through a dividend or lump sum return at the end of the investment. Automatic investing on most platform. However, property equity crowdfunding also have a disadvantage. What is the advantage? Is difficult to equate. So your money, unlike the REITs, you can sell it anytime, but equity crowdfunding, you cannot sell your shares easily because you have to wait until the maturity of the property equity crowdfunding. Rather, can I say, is a higher risk compared to other types of investment because you have to wait until the maturity of the investment. Okay, but however, there's of course some opportunity to the investors. Okay. Okay, yes, I think I have discussed about ordinary and preference shares. Okay. Equity and preference shares. Hold on. Okay, now we will take a look at the example. Yeah, look at example over here. Okay, let's say this equity, the particular property is financed through equity financing. How we want to deal about it? How we want to look at it? So equity financing, additional issuance of ordinary share 100%. Okay, let's say over here, example number 1, ABC's neighborhood have existing capital of ordinary share of 50,000 of 1 ringgit at par, and that is 50,000 unit of shares. Intend to acquire a single story shop at 450. The deposit, okay, the company existing have 50 unit of share of 1 ringgit each. So meaning to say the capital or the existing capital shares, ordinary share is 50,000. Okay, but they intend to acquire another single story shop office shop lot that worth 450,000. The deposit is 10% as a down payment, and the property acquisition is made. Okay, the property acquisition will be made through the existing capital. The company need to bear legal costs of 6.5, MRTA at 4.5 of the S&P. So this is another cost add up to the cost of the property. So the cost of property will be here 10%, meaning to say you have for the acquisition price is 450. Okay, 450. So you have to less the deposit. How much going to be? That you're going to have 405, isn't it? Because you have already deducted the the deposit that is 45,000, isn't it? So you have remained 405,000. Okay. However, you need to add up the cost of the MRTA, that's 6.5 out of 450. And then you have another MRTA, this is a legal cost for 6.5, MRTA 4.5. So you're going to have another additional cost of the two, the legal cost and MRTA cost of the selling price. So you have to add up. You have to add up the legal cost and the MRTA. MRTA is the insurance, yeah. MRTA. So MRTA, insurance. So you, and then however, you're given information that this company receive 3,500 a month and increase 5% of on every year. So the maintenance cost is expected to incur at 25% of the rental of the years. And the company intend to finance the property acquisition of remaining associated with the equity financing. The company will issue another issuance of ordinary right issue of 100 ringgit at par as a mechanism to finance the property acquisition. Let's say after 6 years, that particular property able to be sold at 650. Okay, the dividend policy of the company is to distribute 60% of after interest and tax as a dividend distribution. And the property and the corporate tax is at 24%. So you have to calculate the before tax cash flow and after tax cash flow interest of return. Okay, interest of both cash flow and the capitalization rate of before and after before and after cash flow. Okay, what you need to do is actually, as I said just now, step first, you have to determine the amount of equity financing. So the property price is 450. The deposit is 45,000. And then the legal cost, how much is legal cost? Legal cost is at 6.5% of the property price. 6.5%, you're going to get at 29,250. And then the insurance cost, that is 4.5 of the property price, that is 20,000 to 20,250. So altogether, you have to add up this one, 450 minus 45,000 plus the legal cost, that is 29,250 plus the MRTA insurance, that is 20,250. You're going to get 454,500 as a equity financing amount. Now, this total equity financing amount reflects that this is the amount that you should be issuing for the financing of the property through equity financing. So this indicate that the numbers of share is 1 ringgit at par per unit. So additional amount of ordinary share that you need to issue is 454,500, right? Ringgit Malaysia. So the numbers of ordinary shares is going to be that you have to divide this one with 1 ringgit. So the numbers of ordinary share is 454,500. Okay. And then this is the number of existing shares. The numbers of existing shares in the company is 50,000. So meaning now the new total numbers of ordinary share is 504,500. This is the numbers of new shareholder or the numbers of new numbers of ordinary share in the company. And you will be given an information that this property will be selling at the price of 650 after 6 years. After 6 years, isn't it? Yeah, 6 years. 6 years, okay? Take out the thing. Step 2, you have to construct the income statement for the financial year ended for ABC Berhad. So, first of all, what is the rental you're going to receive? 3,500 rental monthly, right? You have to time 12. When you time 12, the monthly rental going to be 42,000. 42,000, isn't it? So 42,000 for year 1, 42,000 for year 2, and then it's going to increase every 3 years. So every 3 years should be over here. I think this information is wrong. It's supposed 3 years. 5% is supposed to be here. Okay, not here. This is wrong. Okay. And then, of course, over here, you have to less the maintenance. What is the maintenance? The maintenance is 25%. And then you're going to have, is you have any preference share dividend? No, you don't have any information on preference share dividend. No need to take care of it. Just leave it there. And you're going to derive profit before interest and tax and the amount. You have interest? No, you don't have any interest expenses. Leave it blank over on the interest part. And you're going to get, this is the profit, this is taxable income. And you are being given that the taxable that over here is 24%. 24% of the amount, of this amount, okay? So 24% of this amount is 7,550. So you're going to get 7,560. And after in profit after interest and tax is actually you have to deduct taxable income, taxable amount or taxable income with the tax amount, and then you're going to get like over here 23,950 for the first year. And then you are being given information that this policy or the company policy is to distribute 60%, 60% of the dividend as dividends. So you have to distribute 60% of the profit from here as a dividend, and another one is actually you have to distribute another 40% as profit as a retained earning, and that's going to be accumulated in the balance sheet. What is you are being given also information that the numbers of shares, ordinary share in the company, number of ordinary share in the company, that is 500 over here as we calculate just now, 500 for 4,000 numbers of shares, 500 for 4,500. So you have to divide this profit with the numbers of shares. You're going to get the DPS of the ordinary share is actually 1.9 cent. 1.9 cent. 1.9 cent. See over here, 9.1 cent. And same goes to the rest. The same procedure goes to the rest. Okay. Okay. Then the step 3, you have to construct. That just now you construct the income statement. Now you have to construct before tax cash flow for the ABC. So before tax cash flow for the ABC over here, this is we start with year 0, year 1 until 6. And then you have initial, what is the cash outflow? Cash outflow over here, you need to have a kind of cash outflow. Over here is 45,000 as a deposit. It's deposit that you have to pay. And then over here, you're going to pay out the equity financing from the raising of the fund, that is 454,500. How you get this figure? This figure is actually you will receive this figure. In the step 1. This is the amount of financing that you're going to get from the public, because of you want to raise the fund through equity, right? So over here, the amount of that total cash outflow will be the 45,000, the deposit amount that the company will have to pay, and then the company need to pay on the equity financing. Of course, this you're going to get it from the shareholders, but it's going to be owned by the company. The company going to expand it, And then this is the amount of cash outflow. You're going to pay the dividend distribution. Okay, the amount of the dividend distribution is you're going to get it from the statement of income over here. Statement of income. You get it from from step 2. Okay, step 2 and this line. You're going to get this line. This is amount of the dividend that you pay, right? So this is amount of cash outflow of the company throughout 6 years. And in terms of information of cash inflow, this the cash inflow will be the the net operating income. Over here I just deduct, because I didn't deduct over here the maintenance. Should be the maintenance. If let's say I put it maintenance over here also can, because maintenance also a cash outflow. But over here I just net operating income minus is actually a rental yearly and maintenance. So over here I just put here is a net operating income that going to be a cash inflow of the company throughout 6 years. And then I'm going to get the before tax cash flow, the net cash flow, the cash inflow minus cash outflow, cash outflow. So in the year 0, you're going to have a negative, because there's no income received from the no cash received from the cash inflow. But year after that, you're going to have a significant amount of inflow, But and then over here you are given information that at the end of 6 years you're going to get a profit from the sale of the property. Profit from the sale of property is 650, because over here in this case, the company don't have any and didn't take debt financing. So when you take no debt financing, when there is no debt financing happen in the company, the total amount of the selling price going to be recognized as the proceed from the property sale. Property sale. Okay, and over here you have to add up it all, and then okay, then the next step you proceed with the next step, that is that is the how to calculate the to IRR and capitalization rate. How to calculate the IRR? Let's take a look. Okay, this is actually, this information is, this is before tax cash flow. Before tax cash flow. Okay, BTCF. So BTCF, you put it over here, same. I just bring it here because it will be easier. Before tax cash flow, and then okay, how I'm going to derive the figure? I'm going to derive the IRR is at 7.7%. Is actually okay. I'm using over here the discount because we have as normal as an interpolation. We have to use two rate over here. So let's say I interpolate the first figure as 8% and another figure as 5%. So between 5% and 8%, I get at 5% positive, at 8% negative. So I already identified two points. At positive side, at 5%, I'm going to get net present value of 75%. 75%. Okay. 75%. Okay. Sorry, 75,000. Okay, 75,944. At 8%, I'm going to have negative 7,600. So I have received 2 points. So meaning to say over here, the second point, the 8% going to be at below NPV 0. Mean negative, should be negative, right? Negative 7,600. And of course, this thing going to be like, IRR will start with 5%. So 5% as normal, okay, 5%. And then you have to actually 5%, and then this one is actually you have to this one is going to be A, this is going to be B, right? So how the formula is 5%, because we start with 5% in order for us to calculate the IRR. 5% plus okay, plus okay, A plus A minus A divide by A minus B, okay, A minus B, A minus B, and then we have to calculate with the difference between 8% and 5%. Okay, A of course is 75,900 divided by A 75,900 minus negative. So when minus negative is going to be positive lah. Positive lah. Minus going to be a positive. Then the figure should be like over here, you see, as I said just now. And then divide times the difference between 8% and 5%. So you're going to get over here is 7.7%. Okay, 7.7%. Okay. 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 However, when you want to calculate the after tax, okay, when you want to calculate after tax, it's going to be difference. Because after tax, you have to determine the step number 5 is RPGT. Over here, you are given information that the selling price of the property is 650,000. 650,000 less the acquisition price is 450. So the capital of appreciation is 200. Because of the property is actually been hold more than five years, so the RPGT is only 5%. So 5% of the 200,000. So the RPGT need to be taxed is to be paid to the income tax is only 10,000. Okay, out of the capital appreciation. Okay, and then over here, okay, okay, after tax cash flow, this is the amount of tax before tax, but we want to calculate what is the proceed after tax cash flow, the proceed of the selling of the property. So selling of the property is 650, and then you are being charged as RPGT 10,000. So this is going to be after tax cash flow of the company, after the tax cash flow of the company, of the selling price of the property. So you have to construct, this is before tax cash flow. Okay, how we want to get this information before tax cash flow, it will be easy, this one, yeah, this one, okay, before tax cash flow, okay, without considering the profit of this property, and then this is going to be a tax. Tax. How we going to put this amount of tax? Amount of tax is from the step number 3. Step number 3. This is in step number 2. Step number 2, that is the statement of income. So you're going to take the amount of tax that you pay to the government. This is the amount of tax that you pay to the government. This figure, this row, to be used in your step 6. Step 6. So you would to follow from the income statement. You just put it here, and you're going to consider it. You have to minus, so it will be lessen the amount of before tax cash flow, and you have to consider the profit from the selling of the property after considering the RPGT. That is going to 640. So this is going to be after tax cash flow. So after tax cash flow, you're going to run the step number 5. So it's number 4. So you're going to run the step number 4 again. Okay. So this is the amount of before tax cash flow, after tax cash flow, after tax cash flow. After tax cash flow over here going to be this amount, and you have to consider, like say over here, I just put the same interpolation rate, that is between 5% and 8%. So the 8% I'm going to have negative, the 5% I'm going to go positive. So I will be running the same procedure, and I'll be getting the IRR at 6.1. Okay, as usual, we can observe from here, when we consider the impact of the tax, towards the towards our after tax cash flow, our cash flow, our IRR going to be lesser compared to before tax cash flow. Okay? So our IRR, our cap rate going to be lower than after tax cash flow lah, for so before tax cash flow lah. Okay, that is actually example 1, example A. So example B, I'm going to deliver it to the class, in the class. Thank you very much for your time.